Unlock your financial potential and take control of your future with the fundamentals of investing for beginners. Hello, and welcome to our YouTube channel, where we help you learn the basics of investing. Investing can be an excellent way to build wealth and secure your financial future. However, it can be intimidating, especially if you're just starting out. Today, we'll be discussing the key steps to get started with investing, including creating an investment plan, different types of investments, and managing risk. By the end of this video, you'll have a solid understanding of the basics of investing and be ready to take your first steps towards financial freedom. So let's get started. Number 1, create an investment plan. Before you start investing, you need to create a plan. You should start by determining your investment goals. What do you want to achieve by investing? Do you want to save for retirement, buy a house, or build a college fund for your kids? Whatever your goals are, you need to know what they are so you can make informed investment decisions. Once you have your investment goals in mind, you need to create a plan. This plan should include the types of investments you will make, the amount of money you will invest, and the timeline for achieving your goals. By having a plan in place, you'll be able to make informed investment decisions that align with your goals. Number 2, type of investment. Now that you have your investment plan in place, it's time to decide what types of investments to make. There are many different types of investments, each with its own unique benefits and risks. Some common types of investments include stocks, bonds, mutual funds, exchange-traded funds, real estate, and commodities. Stocks, for example, offer the potential for higher returns, but also come with higher risk, while bonds offer lower returns, but with lower risk. When choosing the type of investment that's right for you, it's important to consider your investment goals, time horizon, and risk tolerance. If you have a longer time horizon and a higher risk tolerance, you may consider investing in stocks or mutual funds, which have the potential for higher returns, but also come with higher risk. If you have a shorter time horizon or lower risk tolerance, you may consider investing in bonds or ETFs, which have potential for lower returns. They can be a great way to start investing without taking on too much risk. Number 3, determine where to invest. Once you've determined the type of investments you want to make, it's time to decide where to invest. This involves researching different investment options and determining which ones are right for you based on your investment goals, risk tolerance, and other personal factors. There are a variety of investment options available, including stocks, bonds, mutual funds, exchange-traded funds, real estate, and more. Each type of investment has its own unique set of risks and rewards, and it's important to understand these before making any investment decisions. In addition to choosing the right type of investment, you also need to choose the right investment platform or broker. This can be an online broker, a robo-advisor, or a traditional financial advisor. It's important to choose a platform or broker that offers the features and services you need and that align with your investing style. Number 4, invest only your surplus funds. Investing is a great way to grow your wealth, but it's important to remember that it's not a guaranteed return. There is always a risk involved with investing, so you should only invest money that you can afford to lose or the money that you don't need for your immediate expenses. As a beginner, it's important to start small and only invest your surplus funds. By investing only your surplus funds, you'll be able to avoid any financial hardship if your investments don't perform as expected. You should never invest money that you need for your day-to-day living expenses, such as rent, bills, or groceries. Instead, you should only invest money that you can afford to lose, such as your bonus or your tax refund. Remember, investing is a long-term game, and it's important to be patient and disciplined. By investing only your surplus funds, you'll be able to stay focused on your long-term goals and avoid making any impulsive investment decisions. Number 5, diversification. Diversification is one of the most important concepts in investing. It means spreading your investments across different types of assets and sectors to reduce risk. By diversifying your portfolio, you'll be less exposed to any one particular investment or sector. There are many different ways to diversify your portfolio, such as investing in different types of stocks, bonds, and mutual funds, or allocating your investments across different sectors and geographies. The key is to find the right balance that aligns with your investment goals and risk tolerance. For example, if you invest all your money in one stock and that stock goes down, you could lose all your money. But if you invest in a diversified portfolio of stocks and bonds and one stock goes down, it won't have as big of an impact on your overall portfolio. Overall, diversification is an important part of any successful investment strategy. By spreading your investments across different types of assets and sectors, you can increase your chances of success and achieve your long-term financial goals. Number 6, have realistic expectations. When it comes to investing, it's important to have realistic expectations. You're not going to get rich overnight, and there will be times when the market goes down. It's important to remember that investing is a long-term game, and you need to be patient and disciplined. You should avoid making any impulsive investment decisions based on short-term market fluctuations or hype. Instead, you should focus on your long-term investment goals and stick to your investment plan. It's also important to remember that past performance is not a guarantee of future results. Just because a stock or mutual fund has performed well in the past doesn't mean it will continue to perform well in the future. It's important to do your research and invest in companies or funds that you believe will perform well over the long term. Remember that the value of your investments will fluctuate over time, and you may experience losses in the short term. However, if you stay disciplined and stick to your plan, you can still achieve your long-term financial goals. Number 7, risk management. Finally, it's important to have a plan in place for managing risk. As we mentioned earlier, investing always comes with a risk, but there are ways to manage that risk and reduce your exposure. One way to manage risk is to set a stop-loss order. This is an order you can place with your broker that will automatically sell your investment if it drops below a certain price. This can help you limit your losses if the market takes a turn for the worse. Another way to manage risk is to diversify your portfolio, as we mentioned earlier. By spreading your investments across different types of assets and sectors, you can reduce your exposure to any one particular investment or sector and minimize your overall risk. Another way to manage risk is to stay informed about your investments and the broader market. Keep up to date with news and events that may impact your investments and regularly review your portfolio to ensure that it still aligns with your investment goals and risk tolerance. That's all for today's video on the basics of investing for beginners. We hope you found this information helpful and feel more confident about getting started with your investment journey. If you have any questions or comments, please feel free to leave them below. And don't forget to subscribe to our channel for more informative videos on investing and personal finance. Thanks for watching, and we'll see you in the next one.